Okay, guys, welcome back. We have already started the IFRS 15 revenue standard, and okay, let me check it again. Okay, what we have done till now, we have discussed that what we will study in this standard IFRS 15, and then we have started with the revenue definition that this is all about ordinary or normal trading. So whenever you owning the income from the ordinary business, then you will consider it as your revenue. And then we have discussed that there are some income which you will exclude from the revenue. That is, we have discussed that that will be your non-current asset revenue. If you're selling non-current asset, then revenue should not be part of the income should not be part of revenue. And sell tax, we have already discussed this thing that we will not consider sell tax or will not include in the revenue. Then we have discussed the importance of revenue, that why revenue is important, especially for investor. The reason behind this, we have already done the importance that revenue is equally very important, important a critical metric for evaluating the entity financial performance, and also helping the investor for assessing the market share. And the revenue is also used in the Q ratio, which is gross profit margin. And then we have already discussed about the issues with the old standard, and then we have discussed about the development of IFRS 15, that why we need the IFRS 15 instead of IAS 18. Then we have started the 5-step revenue recognition process model, and that is, first you have to do identify the contract, and then you have identify the performance obligation within the contract, then determine the transaction prices, then allocation of the transaction prices to the performance obligation, and at the last you will recognize the revenue. We have also studied some illustration and then some examples. Now today we will study in detail that first step is identify the contract. So when you recognize revenue from the contract, so check the validity of the contract. For that you have to first you have to understand that what does we mean by contract. Contract is basically an agreement, and this agreements between the parties, let's say party A, party B, or many more multiple party, and this agreement will create enforceable rights and obligation. So it doesn't mean that it always need to be in writing. It may be an oral form, it may be an implied form. So when there is an agreement, and this agreement is create impossible rights and obligation for the parties which are involved in the agreement, so that we will consider the contract. Now the criteria for recognizing revenue from the contract, we have four criterion that have to be fulfilled before recognizing the revenue. The first one is approval and rights. So mean both party have approved the contract. So there must be approval from both parties about the contract, and that contract will be considered for revenue if the remaining the criterion is also fulfilled. So the first criteria is approval, means that both party have approved the contract and their rights are clear. So each party rights, what goods and services are to be provided, are clearly identified. So this means that the contract is approved, plus the rights or clearly identified. Rights or clearly identified, then it means the first criterion is met. Clear? Now the second one is payment term. The term of the payment means how and when the entity will be paid or clearly defined. This means that the payment terms are specified. When the contract is approved by both the parties, rights are clearly identified, and the payment terms are specified, means that how and when the entity will be paid or clearly defined, then it means two criteria has been met. Now the third one is commercial substance, mean the contract has commercial values, meaning it in fact the entity cash flow or financial position. So by commercial substance, we mean that the contract in fact cash flows and has economic values. So when the contract in fact the cash flow or has some economic value, then it means that commercial substance criterion is also met. The fourth one is probability payment, means it must be probable that the entity will receive payment for the goods and services they are providing. So here we have four criteria which must be met before the contract revenue to be recognized. The validity of the contract and the recognition of the revenue validity is confirmed after these four criteria have been met. The first one is approval, we call A, then payment term we call P, and then commercial substance we call C, and then probability of payment, so we call APCP. APCP means if this four criteria has been met, then revenue recognized from this contract. Clear? Let's move on to the next part. First we have to understand this illustration. A customer agrees to purchase services packages from a company for $50. Now this is an agreement, this is a contract where both parties are agreed. One is purchasing the services packages from the company at this amount. The agreement is verbal but clearly defined. The agreement, let's say the agreement is not in written form but it's in verbal oral form. So if the criteria is properly defined, then you will recognize the revenue from this contract. Now the service to be provided. This is the service to be provided. Clear? Payment terms mean upfront or installment. Okay, the service are to be provided means the service package you have to provide. The payment term is also identified, clearly mentioned that upfront money you will get or installment. Then the commercial substance is the service revenue for the company. So this will be revenue, this will impact the cash flow. When you're getting the money, then definitely your cash flow will be boosted up, and this will also affect your other financial statement. Then likelihood of payments and the probability of the payment. So the customer has a good credit history. So when the customer has a good credit history, it means that the supplier will get, there's a probable chances that they will receive the money for the goods services they are providing. So conclusion is this qualify a valid contract under IFRS 15. So the contract is valid because there is approval, both party and rights. Okay, the contract has been approved by both the party, and the right is the one party will provide the services and the other party will get consideration. The payment term is also clearly identified that they will get upfront money or will get money in installment, and commercial impact is also clear. Services will boost revenue for the company services, will boost your cash flow or other impact, and there's the probability that a customer has a good credit history. Clear? Now the second step is identify the separate performance obligation. This is very important. You have to identify within the contract, this is a contract, and this contract you have to identify the separate performance obligation. There may be multiple performance obligation, so you have to identify each performance obligation. Now performance obligation can be defined as that is the promises to deliver distinct goods to the customer is a part of contract. Means this is the performance obligation is actually the obligation that you have to perform, because these are the promises within the contract to deliver distinct goods and services or services to the customer, and this will be a part of your contract. Example of the contract with the multiple obligation, I have told you that this the performance obligation may be multiple. For example, you are selling car sale with a pre-servicing. So here we have two performance obligation. The first one is car sale, meaning you are just selling the car, okay, and the second is pre-servicing. You are also providing services for the product you are selling. So selling a car is one obligation, one PU, and providing 1 year of servicing is different obligation. Now you have to recognize the revenue for these two performance obligation and different way. For example, you're selling the car, so you are transferring the control of the asset, let's say on 31st December 2003, let's say 2003. So you'll recognize the revenue for the car and this date. Now the services will be provided for 1 year. So if you are recognizing revenue on 6th June 2004, then you will only count for 6 months, because the remaining 6 months will be your accrued income. It means that this you have received the money, but you have to provide the services later on. So providing 5 lectures plus textbook on the first day, so this is the one obligation, this is the second obligation. Clear? Okay, now what we called that is a good services or distinct or not. So there are two main point you have to remember for the goods and services to be distinct. The first one is benefit to the customer, the second one is separately identifiable. Clear? So performance obligation of promises in a contract to deliver distinct goods services to a customer. So we have to know what does we mean by the distinct good or services. So the good or services is distinct if the customer can use the goods or services on its own or with other readily available resources. So mean the customer will get benefit from the resources from the goods or services on its own, or they may use it with other readily available sources to get benefit. The second thing is separately identifiable. So mean the performance to deliver goods or services is independent of other promises in the contract. As you see here, the sale of car plus providing servicing, so this is distinct, this is independent from the servicing is independent from the sale of the car, and the sale of car is independent from the servicing. Okay, both of them providing benefit to the customer. So that is why we consider these are two PO, mean performance obligation, because the customer can benefit from these services, goods or services, plus these goods or services are identifiable separately. They are independent of other promises in the contract. Clear? How to identify performance obligation? how to identify performance obligations. So review the contract terms to identify the individual promises. So once you read the contract, then you will identify the individual promises. Clear? Let's say in this we have a contract, and the contract there is a car plus servicing. So in the contract you review that there are identifiable individual promises. The first one is car, the second one is servicing. Now assist with each promises meet distinct criteria. For distinct criteria, we have studied that it will give benefit to the customer, and the second thing, it is separately identifiable. So if you see here, car and servicing both can benefit to the customer and both can be separately identifiable. It means that they meet the distinct criteria for good or service. So each distinct promises becomes separate performance obligation for revenue recognition. So it means that you have to recognize revenue for car and also revenue for the servicing. Clear? Okay, now a company, this is a company, this is actually an example. Contract, a company sell a smartphone with 1 year subscription to the music app. So here we have to review the contract. Okay, first you have to understand that it's meet the criteria or not of the contract. We have already discussed that APC and CP. That one is approval. A for approval, P for payment term, C for commercial substance, and probability payment. Once you pass this step number 1, then you will move to step number 2, and that is identification of the performance obligation, separate performance obligation. Now in this contract there are two separate performance obligations which will meet the distinct good or service criteria. The smartphone is the one obligation PO, and 1 year subscription is the another PO for performance obligation. So good or services promises smartphone and music subscription. Now assessment is that smartphone distinct. Yes, this is a distinct goods because the customer can use it on its own and the customer will get benefit from it. Music subscription is also distinct because it is separate services independent of the phone. So these both are separate goods services, and these are also meeting the criteria of distinct goods services. So the two performance obligation exist in the sale of the smartphone and the subscription services. Clear? Okay, now you have two type of status. The first one is principal status, when you are acting as a principal, and when you are acting as an agent, and how you recognize revenue. When you are acting as a principal, what does it mean? It means that the principal provides the specified goods or services directly to the customer. This is the first thing. Principal provides specified goods or services directly to the customer. So revenue recognition for, if you are acting as a principal, the total transaction prices will be your revenue, full amount charged to the customer is recognized as revenue. Now key criteria is the entity control of the goods service before transferring it to the customer. Let's say you have this box, okay, and you are selling this to the customer. So it means that you are a supplier, and you can also say that you're the principal because you have the control of this asset and you're directly selling this to the customer. So this means the box control is with you before transferring it to the customer. So you have to recognize revenue for this. Let's say you are selling this with $100, then you will recognize the full total transaction price 100 as your revenue. Now if you are acting as an agent, agents arranges another party, mean the principal, to provide goods services. Let's say you supplier, you are selling the boxes, and here is an agent, that is Mr. B, and he had just made a platform like in a website, and through website the customer come to the website and they purchase order for the box, and this agent is not responsible for selling that product, but they are just providing the platform for the customer to purchase the box from you. Okay, now how the revenue will be recognized by the agent. Agent is not controlling the asset before transferring it to the customer. So here the agent will only recognize the fee or the commission they will earn on each transaction. Okay, the agent arrange another party, mean the principal, the supplier, to provide good service to the customer, and the revenue recognition are only the fee or the commission that the agent is entitled to recognize as in revenue. So if the supplier have an agreement with the agent that they will pay let's say 8% per transaction, then the revenue for this agent will be 8%, not the whole amount, the total transaction price for the goods services. Clear? Okay, how to determine if the entity is a principal or agent. So there is a criteria, this is some indicator you have to remember that you will be considered principal or agent. So indicator of being a principal, the first one is you are responsible, the entity responsible for fulfilling the customer order. So the one who is responsible for fulfilling the customer order is the indicator of the principal, that you are the principal. The second is the inventory risk, means if you are bearing the inventory risk, then it means you are the principal. And the third one is entity set prices for the goods services. So we have just studied three criteria, three indicators. When these indicators you find, then it means that you are acting as a principal. The first one is responsibility for the commitment for the selling or fulfilling the order. The second thing is inventory risk, means you are controlling the asset, you are controlling the inventory, and definitely you will bear the risk. And then you are fixing the price, that which product will be sell at what price. So this is the three indicator that will show that you are acting as an agent, and you will, when you are acting as an agent, then you have to recognize the full transaction price is your revenue. Now indicator for agent, entity, the entity obligation is to, so means when your obligation is just to arrange the goods or services to be provided by the another party. So when you are arranging the transaction between the customer and the supplier, then you will get some amount for that arrangement, and that it means that you are agent. So the entity in obligation is, so your obligation is just limited to the arrangement. Now you will earn some fixed fee, is a fixed fee or commission for its role. So whatever the commission decided between you and supplier, you will recognize that as your revenue. And the principal has control over the goods services, and the agent don't have control over the asset and services. Clear? Okay, so a company sells software directly to the customer, that means that as a principal, so they will just recognize the full software prices. And if you are providing the the platform to facilitate the booking of good for a customer, and you're getting the 10% commission, then you are acting as an agent, and you just recognize the 10% use is your commission. Okay, here we have an example. Here, principal and agent. Now let me highlight. Okay, deals for you operate a website that enable customer to purchase a computer equipment from a range of suppliers. So this means that deals for you have website, and the website purpose is arrangement. They are just arrangement, they are just doing arrangement for the supplier and the customer. Okay, now uh, the supplier deliver the goods directly to the customer. Okay, means the supplier responsible for fulfilling the order, not the agent, not the deals for you. Okay, now when a good is purchased via website, I mean using when the customer using the website to purchase the goods, then deals for you on a commission at the rate of 8% of the sale price. So it means that deals only get revenue will uh, only be paid if they arrange the sale. So and they will get 8%. This is the 8% of the sale rate. So I mean they are just earning the commission only, not the full amount. Now the sale price are set by the supplier. So means the sale price is set by the supplier. This means that the deals for you as an agent because he is not setting the price of the goods or services, but they are just arranging the deal, and the deals for you is only getting the fixed amount of 8% commission. Now all order are non-refundable. Okay, now here if you see here, deals for you is an agent, and why we call this agent? Because it does not control the computer equipment. The who is controlling, the principal is controlling, they are just arranging. Control belong to the supplier who set the prices for its good and responsible for fulfilling the order. So an agent deal for you will recognize revenue based on the commission, that is 8%. Clear? Okay, now let's talk about warranty here. uh, Types of warranty and their accounting. Okay, assurance warranty purpose is to ensure that the product will function as intended, basic protection. So accounting is for the IS 37. You will recognize a provision for the expected warranty cost, because this is not a distinct service or good or services, and no revenue allocation considers a part of the sale of the product. So that will be included in the product price. Okay, now if you are providing additional services warranty, then provide additional services or extended coverage beyond assurance. Then customer option is the customer can purchase the warranty separately at his testing performance obligation, and the treatment will be allocated proportion of the transaction price to the warranty and recognize the revenue over the warranty period as a service is provided. Clear? Here we have yes, you see here. Now here we have example. You see here, a company sell a laptop $100 with 1 year warranty. Now basic warranty assurance included in the price. Extended warranty sold separately at $200. So this means this is your distinct services. Okay, so assurance warranty accounted under IS 37. I have told you before, a provision for estimated repair cost, and then extended warranty treated as a separate performance obligations, allocate 200 to the warranty and recognize over 1 year. Clear? So we have just done the two steps, the first one and the second one is for the IS 15. Inshallah, we will continue in the next lecture about the third step, and that is determine the transaction price. And once you determine the transaction prices, then in the fourth step we will allocate their transaction price to the PO, and at the last step we will recognize the revenue. Okay, thank you for watching.